Hi, my name is Muhammad Amran. Now I will present the two examples of rule-based monetary policy in the world. Rule-based monetary policy gives a central bank a strict set of guidelines that govern its future action. For example, a rule-based policy could require a central bank to undertake expansionary or contractionary policy to maintain a particular price level. First, rule-based monetary policy is Taylor Rule. Named after Stanford economist John Taylor, Taylor Rule specifies a short-term interest rate target for the central bank. The rule specifies a target by taking into account both the rate of inflation and the growth rate of the real economic output. The Taylor rules essentially say that if inflation or output is below their desired growth rate, the central bank should conduct an expansionary policy by purchasing a securities until a lower interest rate target is reached. So, if inflation or output in the economy is above the desired rate, then the monetary authority will raise the target rate by contracting the supply of money, and then this will result the rising in the interest rate. The biggest problem with the Taylor rule is the difficulty in measuring inflation and GDP or unemployment metric. They are actually unobservable in real time. As important as GDP is to economists, it is extremely difficult to measure, at least in the short term. Even minor change in this metric can throw the Taylor rule off, resulting in monetary policy that worsen rather than improve the economy. The second rule-based monetary policy is the inflation rate targeting rule. Inflation rate targeting rule requires the central bank to keep inflation, the rate of change in the price level, within a certain range. The central bank forecasts the future path of inflation and then compare it with the target inflation rate, where the rate the government believes is appropriate for the economy. And then the difference between the forecast and the target determines how much monetary policy has to be adjusted. For example, the federal may be required to keep the Malaysia inflation rate between 1.5% and 2.5%. Under this rule, if the rate of inflation rises to 3%, the federal will conduct contractionary monetary policy to bring the rate back into the required range. If, on the other hand, the inflation rate falls to less than 1.5%, the federal will implement expansionary policy to raise the rate of inflation back into the target range. Many benefits of inflation targeting rule have been proposed. Chief among these are: first, reduced inflation volatility; second is a reduced inflationary impact of shock; and third is increased anchoring of inflation expectation. While one obvious benefit of inflation targeted rule should be lowering inflation, the additional core benefit also increase communication with the public and market about monetary policymakers' plan and objective, as well as increased accountability of the central bank for achieving its inflation target. If inflation rate targeted rule were implemented as a very strict policy rule, it could have some serious problems. The first is the restricted ability of the central bank to respond to financial crisis or unforeseen event. Second is potential instability in the event of large supply side shock. Besides that, the problem is a potentially poor outcome in employment, exchange rate, and other macroeconomic variables besides inflation.
For the question 2, recently the United States government is scaling down the magnitude of unconventional monetary policy that were launched to overcome the economic effect of COVID-19. Elaborate 2 reasons that justify this decision. So next I will explain about question 2. In 2020, that under influences of the epidemic, the United States resumed unconventional monetary policy tend to result in a serious relapse of its monetary policy. In the perspective of China's deep integration into the global economic and financial system, a change in United States monetary policy will have an impact on China, and China must respond positively in that impact. As a result, a systematic and in-depth analysis of the history, characteristic and effect of the unconventional monetary policy is obligated. Shortly after the supreme mortgage crisis, The United States imposed traditional monetary policies such as interest rate cut, open market operation, and direct bailout of systematically important financial institutions. We can see in the figure on March 15, the Fed has cut out the federal fund rate by 100 basis points to 0.25% and announced a $700 billion quantitative easing plan. Furthermore, the open market has expanded through overnight and regular repurchase operation. The Federal Reserve announced on March 23 that it will purchase necessary skilled government bond and institutional mortgage backup security, as well as institutional commercial into the purchase category. The Fed has not set a limit on the size of its asset purchases, resulting in unlimited quantitative easing. And in practice, this round of quantitative easing has already accessed the $700 billion originally announced. The Fed has expanded unlimited quantitative easing to as in almost $3 trillion in quite short period on time of May 8th, and its balance sheet has obtained an all-time high of $6.9 trillion. The United States unconventional monetary policy has not only led to rising on emerging market currency, but has also resulted in a continued widening of interest rate differential. Under the influence among these two factors, the liquidity created by the United States through unconventional monetary policy flow into emerging economies with relatively high interest rate and fairly rapid economic growth. Cross-border inflow of funds have increased the money supply in other countries, resulting in credit prosperity while somehow increasing the asset price of capital inflow countries. And thus increase in asset price has promoted further capital flow. As a consequence, the United States unconventional monetary policy not only promote currency appreciation in emergency economics, but it also lead to an increase in emergency economic leverage ratio and the emergence of asset bubble, something that greatly raised the risk of economic operation. The main factor driving large-scale capital flow in emerging economies are change in U.S. monetary policy. As the U.S. gradually withdraw from its loose monetary policy environment, emerging markets will suffer significantly, characterized by high external debt ratio, large deficit ratio, and short-term international capital inflow. When one's economy exits from unconventional monetary policy after the crisis, benchmark interest rate and liquidity will tighten. The U.S. restrictive monetary policy will cause a large outflow of international capital from emerging economies, causing domestic asset price in those countries to fall. A large outflow of capital might result in a large amount of sales of emerging market currency and purchases of major currency in the foreign exchange market, resulting in currency depreciation of emerging market currency and increased exchange rate volatility. Falling exchange asset price and currency depreciation will exacerbate the outflow of international capital from emerging economies, creating a vicious circle and in the worst case scenario, a currency crisis. Furthermore, depreciation of local currency will increase the debt burden of emerging market economies, causing greater shock in some emerging economies with higher external debt and economic vulnerability.